Hey guys, today we are looking at a monthly dividend stock that has investors salivating with that fat dividend payment that comes every month. The company we are talking about is Realty Income Corporation, ticker symbol O, and what this company is, why it's a good investment, why you'll be getting that monthly dividend, and also is the stock even undervalued despite all of those great points already. Well, what is Realty Income? It is a real estate investment trust, otherwise known as a REIT, which invests in freestanding single tenant commercial properties across the United States. Here it was founded in 1969. It was a member of the S&P 500 and it has a very large portfolio of tenants. Some of these include 7-Eleven, Walgreens, Dollar General, FedEx, Sainsbury's, LA Fitness, AMC Theaters, which everyone likes at the minute, Walmart, Sam's Club, and a whole slew of tenants, totaling around about 10,000 properties with over 100 million rentable square feet. So why is this stock interesting? Well, it pays a monthly dividend that we're going to be touching upon in. But first, let's have a look at the fundamentals of the stock to see if it is still a buy. So is the PE ratio less than the market? Well, before we get into that, currently Realty Income has a market cap of just about 40 billion. Share price is $71.71. It has a 52-week low of 57, and its all-time high, which was at the top of the just before the pandemic, was around about 76. So it was actually even higher than that. So that's a 52-week high, which was in November. Before that, it was at $82 a share during the pandemic, before the pandemic. So can it reach up to those levels again and as well pay that very nice dividend? So let's have a look. Is the PE ratio less than the market? No, it is not. 56 to 28. So that is a fail. Next is the revenue increasing. Yes, revenue's gone up 1.3 billion to 1.8, so that is a pass. Next is their profit increasing. Yes, it is 363 million to 473 million, so that is a pass. Are they buying back their shares or issuing new shares? Ooh, no. It has gone from 288 million shares to 343 million shares. So why is this bad? Well, for example, if there were 10 shares of a company and you owned 5 shares, you would own half the company. But then if the company issued 20 more shares, you would still only have 5 shares, which means you would only own 25% of the company. So you're getting less cash, less earnings per share, and it would devalue your stake in the company. So that is bad that they're issuing new shares. But is their free cash flow increasing? Yes, just shy of $1 billion, 940 million to 1.2 billion. So that is a pass. So overall, we have 3 passes, 2 failures, which was the PE ratio on the shares outstanding. The free cash flow ratio is 30.1, which is the market cap divided by the free cash flow. So this isn't too high. I would have expected this to be a bit more in line with the PE ratio, but the actual profit is a bit high, but the free cash flow is a lot higher because this is a free cash flow company. Interestingly enough, their total dividend paid is 1.6 billion, which is more than the free cash flow, which is 1.2. So that is a bit of a negative mark. I have looked at this, but it seems to be a bit more of understanding here, because if you go to that website here, they're showing dividends paid to common stockholders in relation to their revenue, which is up. So obviously they've got more revenue than their dividends. But the actual free cash flow, which will be used to pay it, is an increase, which is actually more. So that is very interesting. But this might be just part of how the REITs work. Next, we want to look at the valuations. So we're going to use discounted free cash flow and a Buffett Graham intrinsic value to see what the valuation of the stock is. And we've calculated the future free cash flows. And this gives us a value of $103 a share, which is currently trading at a 44% discount. So this is very good to see. And if we look at the Buffett Graham intrinsic value, this doesn't like the stock as much. I think it's because of the low earnings per share and expected growth rate. Has a fair value of around about $24 a share, which is very, very low compared to the actual share price. But I think maybe we want to be looking at the discounted free cash flow here. But it is good to see that the discounted free cash flow says that the stock is undervalued, so it does have room to grow, and it is still paying that monthly dividend. If we just have a look at tip ranks as well, analysts are agreeing. They're saying the stock is a little bit underpriced at the minute on the average. Even on the lower side, they're saying the stock will be about the same price this time next year. Bit higher, 9%, but even highs is 83, which is about 15%. Then including that nice 4% dividend, you'll probably be beating the market with a very stable stock. So that is good to see. So this is definitely interesting. Anyone who wants to have a stock for monthly dividends, this is one of the best out there and has a consistent history of paying those monthly dividends. Right, guys, thanks for watching the video. Please give a like if you enjoyed it, and I will catch you guys next time.